Have we seen some recent slowing in the housing market? And you're thinking maybe that's due to bubble conditions and we're actually headed for a crash? Well, let's talk about that. My name is Nick with the Iannitti Group. I want to come at you with a real quick housing update, kind of nationwide here for May of 2022. So, are we headed for a housing bubble? No, we're not really. This is, as far as bubble conditions existing, I think what we need to do is provide a little bit of historic context, right? If you think about it all the way back to 1945, this is basically with the advent of the GI Bill. This is really the start of the current housing boom that we've had. And when you look all the way back since World War II, realize that housing has never had a significant downturn, right? With the exception of 2008. That's the only time we ever really saw significant loss in values when 9 million people basically entered into the foreclosure market. And what we have to realize is that the housing market that we have today is really nothing like that market whatsoever, right? When we look at forbearance, this is the other shoe waiting for us to drop, is basically, what was going to happen with COVID. And now we're going to have to deal with post-COVID, as far as interest rates and inflation. We'll talk about that here in just a second. But when we're looking at, stability of the market right now, our forbearances are way down. Of the people who did enter into forbearance during the pandemic, 37% of them are already out. They're already paid in full. 44.5% of them have already worked out something going on. And then that just leaves 18.5% that still need to figure something out. But just realize this 18.5%, they have options. They're not underwater in their homes. They could very easily sell that home, pay the commissions, and still have a small profit, and then deal with whatever financial hardship their family's dealing with. So this 18.5% is not enough to move the market. The number is just too low. Okay. But what we did learn from history, obviously, is that prices can't come down. So the better question is really, could that happen right now? And really, it's kind of difficult to say at this point in time. Again, back to how we look at our current market versus where we were. These are a couple of different things as far as the two main contributors from the lending standpoint. This red right here are risky loans, right? Realize that this type of loan product doesn't really exist anymore. It's no longer offered. It hasn't been offered in years. And this brown right here is basically the credit worthiness of the borrowers. You can see how that, as the risk has gone down, we've gotten much better borrowers today, which does provide more stability in the market. We can see it in something like this too. This is basically mortgagees, basic borrowers who have a mortgage and they have a credit score less than 620, right? This is in the billions of dollars. Look at how much we loaned before the crash. Since the crash, it's a completely different borrower that we're looking at right now. We don't give those people access to the same amount of money as we previously did, which has essentially led to, all-time low foreclosure activity. There was also a moratorium on foreclosures right in here, but realize again, back to that 18%, it's not going to be enough to move the needle. But people also say, look, with these incredibly high prices now and rates are going up, the mortgage debt, people aren't going to be able to pay these mortgages. That's the real concern. Well, it's not a concern. When we look at, the debt service ratio as a percentage of people's disposable income, you look at where we're at today, 3.8%. We're far better than we were back before the crash. We're even better than we were all throughout the 80s and 90s. Okay, so we need to definitely keep that in perspective. The other equation, the other second part of that, previous crash was cash out refi, people pulling the equity out of their home. If we look at, how things are at today, nowhere near the same levels as we were back then. But this is the debt people were willing to take on in order to get at that equity. We just don't see that today. So what's ahead? We still really have to look at price increases as a function of inventory. I talk about inventory every single month. We've been building below our historical average for 14 years now. We have a deficit of about 4.8 to 5 million homes here in the country, and we're not going to solve that anytime soon. And that is basically leading, here from the Home Price Expectation Survey. It's a survey of the national economists, a lot of them all across the country, and they're basically saying, look, we're going to see about 9%. Home price appreciation here in 2022, and then going over the next 4 years, we're going to see things start to moderate, right? I've been saying this for a couple of years now. This 18% appreciation year over year, it's just not sustainable. Eventually, yes, we have low supply in homes, but there will come a time where we exhaust salaries. People won't be able to pay those prices, and at that point in time, we'll probably reach some balance. No one's really calling for prices to come down, especially not a crash. A crash would be like a loss of 10% of value or more. we're basically saying over the next 4 or 5 years, we're still going to see home prices increasing. They're just going to get back to more of a historic rate of increase. This is how homes appreciated over the past 50, 60, 70 years. It was 3 to 4% a year, at a time. And we'll probably get back to that. This is just, again, those same economists, how they're split basically and where they're at. But this again is the home price estimation survey right here. When we look across the board at the rest of the industry providers, we're still looking at about a 9% average in home price increase this year. Okay. Bill McBride thinks basically 30-year fix this year. The mortgage rate's probably going to wind up being somewhere between 5 to 5.7%, maybe as high as 6. We've already seen them creep up to 5.5 and then come back down to 5.25. So that 6% by the end of the year is absolutely doable. Realize right now the Fed doesn't have much of a choice. Inflation's so high, the only real tool they have left in the toolbox, other than producing more energy, would essentially be to raise the interest rate. Right, that is historically the brake on inflation. So they really don't have a choice. But what we need to look at is actual affordability. Remember, this is not affordable housing. This is housing affordability. They're two different things. When we're talking about housing affordability, we're talking about people's, really the majority of people here in the United States shop bases a monthly number, right? A monthly budget, right? We know now this latest Harris poll came out, 84% of Americans are cutting back on spending due to inflation. 70% of them really feel it at the gas pump and at the grocery store. I'm surprised that 70% isn't actually higher. But what it looks like in a mortgage payment is this. Typically 1% increase in mortgage rate decreases a buyer's purchasing power by about 10%. Okay, so looking at just this example in a $300,000 mortgage back in January 2021, it was going to cost you about $1,200 a month. That same amount of money now is probably going to cost you $500 more a month at $1,700, right? That's significant, especially as this number goes up. When you're talking about buying a $600,000 home or $1 million home, what that increase in monthly payment has done is it's halted a lot of people in their tracks, because that additional money is what they needed to essentially get that extra bedroom or get into a school system or some product that offered a view or something else. And now all of a sudden they can't trade their home for this next step up. They've had a reduction in purchase power, so they're choosing to wait a little bit longer, especially if their current home has a mortgage on it below 4%, right? So that's what we're starting to see over the past 2 months. Things have definitely slowed a bit. We still do have buyer demand, but things aren't flying off the shelf. If you had someone in your neighborhood that sold their house back in February with 15 offers in one day, we're probably not in that same situation right now. So if you're a seller, you need to realize that there has been that shift. But talking about affordability again, just again, back to some historic perspective, okay? This average, this dotted line is the average. Everything above it is more, the higher the bar, the more affordable it is. So when we look at the crash, obviously things are more affordable, right? They have been over the past 10 years or so. When we look at this year, we're definitely less affordable than we were last year. We're actually very much less affordable than we were over the past 10 years or so. But again, back to the historical context, you look at where we're at today, we're still really far more affordable than we were all throughout the 90s. Okay, so that's important to actually keep in mind. Although obviously inflation is a real thing, we're seeing the average consumer now, their monthly costs have increased by about $430, and that does not include housing. That's just all the other stuff that they have going on. Meanwhile, their wages have really on average only grown by about $212. Okay, so it's not enough. And what that's doing is, on average, someone who is in the housing market, it's costing them to shave about $42,000 off their purchase price, in some places even more when you're talking about higher prices. So that's about it. If you guys have questions about these numbers, if you want to know, hey, what's happening in my neighborhood, what's my home worth, is now a good time to buy or sell? By the way, if you're renting, still a good time to buy. But just reach out. I'm more than happy to answer those questions for you. I'll also be doing a market update on San Diego and Sarasota, just in some nitty-gritty housing numbers. So check those out as well too. And that's it. Thanks so much for tuning in. Remember, who you choose to negotiate for you absolutely matters.